Hey, welcome to Dow Stock Talk, where I talk about topics relating to investing in finance, but more specifically the stock market. In this video, I'll be doing a stock analysis on Netflix. I know a lot of you have been seeing Netflix fall actually 40% from its high, so I'm definitely going to do a stock analysis to see whether you should buy the dip on Netflix. And in this video, I'll be doing a company overview, key highlights, streams of income, financials, risk factors, competitive advantage. I even threw in technical analysis, my personal insight, and whether I think Netflix is a buy. But before we get started, make sure you smash the like button because it helps the YouTube algorithm. It helps YouTube know that this is quality content and help my videos reach a broader audience. And also, this video might be a little lengthy, so I provided timestamps so you can skip around to your likings. Now, I know lately I did a lot of alternative investments and investing platforms, but in this particular one, I'm going to focus a lot more on stock analysis. It's been a while before I actually did a stock analysis, so I'll definitely do it. And by the way, if you wanted to see a stock analysis on a particular company, make sure you drop it in the comments below. And also, if you're a big fan of finance and investing, make sure you check out my store, Wall Street Stock Apparel, where I make custom finance and investing t-shirts. So let's just jump into it. So of course, everyone knows Netflix is an internet online streaming service. It's where they have unlimited or a lot of movies, TVs, documentaries, and all types of things you can think about. But let's look at some key statistics about Netflix. So if we scroll down, Netflix in 2020 has generated about $25 billion in revenue, up 23% year over year. Now let's also see I just wanted to point out some key things. As we look in at the revenue, let's also keep in mind that revenue is sales. So this is before costs and all that stuff. As you can see, the revenue has been increasing. By the way, these are in billions. So we've seen a huge increase during the pandemic, of course. We went from 4 to 5 to 6 to 6, 7, and we're closely approaching about 7 billion and these are, by the way, these are quarters. So each quarter is showing the amount that Netflix made. This, as you can see lightly, the revenue growth has been slowing a little bit, but we're still seeing a increase in revenue, which is also a good thing. And if you wanted to actually just kind of see Netflix revenue, we went from 2011 was 3.1 to all the way $25 billion in revenue. We went from, in 2018, we had 15.7 billion, and from 2020, we had about 25 billion. Now let's just look at the geographics of a breakdown of where most of their revenue come from as far as country. So if we look at the country, as we can see, most of Netflix subscribers come from the US and Canada. So most of it, in that particular case, you have out of that 25 billion, 11.45 billion comes from US and Canada. So a lot of the growth could become in Asia and Latin America if you was looking on the optimistic side. Now also, let's look at the average revenue per user. So as you can see, the highest amount is in US and Canada. I just want to show you the breakdown, and let's also look at profitability. So the good thing about it is profitable. So as we can see, we had from 2018 1.6 billion to 2019 2.6 billion, and then it actually doubled to 4.5 billion. So that's always good to see. And we also looking at the amount of money they spend on content. So the more money they spend on content, they're hoping that it'll pay out, so it attract new subscribers. So this is the thing, they're spending from 2020 they spent $11 billion to 2021 they spent $17 billion. And also this is the key and butter, Netflix subscribers. And I'll talk about that a little bit later. So as you can see, they went from, I like to scroll down here so you can kind of, from 2018, 124 to 151 to 192. So subscribers are increasing nicely, as we can see. And let's look at, as far as US streaming. So Netflix control the industry with 34%. YouTube is behind at 20. Hulu is at 11. Amazon Prime, definitely watch that. Disney Plus and others. The streaming platforms regarding, movies and stuff like that. This is the breakdown. Now, if we look at the catalog, Netflix has 3,600 movies, 100 and 800 TV shows. As we see, the only one that has more than that is Amazon Prime. Didn't even know this. 26,300 and 2,700. But I think the Netflix platform and interface is much better than Amazon Prime. Now, I'm going to switch it up a little bit because Netflix had a lot of major news. It's down 40% from its all-time high. So the biggest concern now is the subscriber growth. It's supposed to grow a lot slower than it did before. So that is critical in the Netflix business model, and pretty much all of their money comes from subscribers. So that is a good thing to know. I'll get into that a little bit more. And they also missed their target. They was hoping to add 8.4 million new subscribers, and they just missed that. That's what's really causing the major dip, because all they can just do is generate money from subscribers. So there is a lot of concern whether Netflix will continue to grow, and right now the market has priced Netflix as a growth stock. Yeah, guys, so this particular day, January 20th, 2022, this is the shareholders letter that they end up receiving. It should be on the Netflix website, all the way down. If you scroll down, let's scroll all the way down to investors relations. If you wanted to find where this at, you just click on financials. Once you click on financials, then you would just scroll down and you see letter to shareholders. You click that, and that is how it comes up. So these is the shareholders. They keep shareholders informed. From Q4 2020, the revenue growth was 21.5, and then recently all the way to the last quarter 2021, revenue growth is 16%, and it's projected, and this is where the key concern is. It's for going forward, it's only supposed to grow its revenue 10% year over year. For a growth stock, this is not something you want to see. You would definitely want to see in general 20% revenue growth year over year from a growth perspective. Scroll down. This is what I was saying as far as the paid subscribers. A lot of times they have crushed their expectations, but on this one they end up falling short. 8.3. Their goal was 8.5. So when you see the market is expecting you to exceed expectation and you go below it, and then you forecast a much slower growth, the market did not like this, and we've seen a huge sell-off. And also, let's look at their annual operation margin. We don't like to see that decrease. They have been spending a lot more money on their content, which is increasing their costs. Hopefully that will pay out in the long run, but their annual operating margin is 19%, which is small. I would like to see 30% margins or better, but because it's streaming services, it's very it's getting narrow. So the more money that they spend on content and stuff like that, it will definitely shrink the profit margins. But hopefully over time that you can charge a lot more because they have a lot more premium content. Because they had Squid Games, everyone was talking about it, and WandaVision and Loki, Sweet had a lot of big hits. I'll go over the streams of income, how they make money. So it's pretty much a subscription-based business model. So they only make money based off of people subscribing, which is they have the 3 different plans. I think it's ranged from $10 to $15 to $20. I can't remember offhand. Now, as you can see, this is from their financials from the 10K. I'm looking at year by year. So as you can see for the financials, most of their revenue come from streaming service, which is subscription, and they do still have where people can actually rent DVDs, but that's such a small part, and of course that's going to be decreasing over the year, but most of it is coming from streaming. At this, we're looking at total revenue. So in 2019, we're looking at, it was about 20 billion, 2020, 25 billion, 2021, 29 billion. As we can see from 2020 to 2021, the growth was 19% year over year. Normally for growth stocks, you would like to see 20 or better. You do see a decrease in DVD revenues, which is DVD rentals. What makes sense because we're in a digital age now. Now, jump into their competitive advantage. They're pretty much the first mover, so they're pretty much the first big company to do a online streaming service. They took out blockbusters completely. They invest a lot of money. They have been doing this for a while. They invest a lot of money into movies, TV shows, documentaries, and the whole Netflix original. Everyone else is starting to invest a lot more money as well, but Netflix been doing it for a little bit longer, and a lot of people are familiar with Netflix as the household name. A lot of people, that Netflix and chill. But anyway, okay, and next we're going to go over their risk factors. As you can see, this is in the 10K. We can look at their risk factors, a lot of documentation there. But I'm just going to briefly tell you of the major one. A lot of things are moving online. So you got a lot of companies are jumping into the streaming service industries, and we're talking about a lot of big companies. We're not talking about any small ones here. We're talking about Walt Disney, Spotify, Roku, Amazon Prime, Peacock, Amazon Plus, Warner Brothers. So they have a lot of particular competition. Now, another one of the also biggest risks is Netflix right now is one-dimensional. So right now they only make money based off of subscribers. So once the subscribers end up starting to slow down, that means their revenue and income will slow down as well. Not unless they can, increase the cost. But the more they increase the cost, that could actually create a decline in subscribers because other ones will seem more attractive. And also another risk factor I would say is the amount of money they spend on content. So if they have to spend a lot more money on content to stay relevant and keep their subscribers, that will also reduce their profit margin as well, in their income and their their earnings. So it really would affect their earnings if they spend a lot of money on particular content. Yeah, so first I'm going to hop in Yahoo Finance, so where this is where you can quickly see how their revenue and profit and all that stuff is pretty much doing. But I just wanted to focus on something really quickly. But if we look at quarterly, this is, I think, some of the concerns as far as the earnings. The earnings has actually quarter over quarter, besides this one, actually been decreasing. I'm expecting because they spend a lot more money on their content, so hopefully it pays out in the long run. But in the revenue, as you can see, it's not increasing as much, so that is some of the concerns, and that's probably why you see a huge decrease in the stock price. So let's look at the earnings. They have been beating earnings, so that is a good thing as far as earnings. Maybe the market isn't, flabbergasted about that, but they have been beating earnings, so that's something also good to see. All right, so next we're going to jump in Simply Wall Street, look at their financials pretty quickly. So as you can see, the stock price, it was all the way at 687 and it dropped all the way down to almost, I want to say 350, 366, but right now it's about 403. As far as, let's look at some fundamentals as far as, sales. So the price to sales is 6. That means if you was kind of looking at it from a business perspective, every $6 they make, you would get $1 back based off of the stock price and the amount of sales meaning revenue. The PE is 35. You can also think about that is for every $35 Netflix have, based off of the share price, you would get $1. So if you want to see a little bit more about that and how to break that down, make sure you check my suggested videos. And also, I like to show you this because it shows the breakdown of the cost. So 29 billion in revenue, 17 billion comes from cost of revenue, gross profit, others to 7.2 in the earnings. That's how they got the 5.1 billion. As we can see, the net profit margin is 17%. That is very low, very low. And also, if we can see the debt to equity, they have a lot of debt. But also, let's look at it from a discounted cash flow. This is a way that you can particularly value a stock from a value investor. So the more cash flow they can produce in the future, you discount it back and you would come up with a price. Now, according to Simple Wall Street, they're saying that Netflix is undervalued. They're saying that they think the fair value is $7.39 versus the current share price is $4.03. So as a value investor, buying undervalued stocks, this is something that would be very attractive. Now, the good thing about it, you have to see, you can't take these numbers blindly. You also have to see why the market has, why the current stock price is at, the business model, and will the future cash flows be messed up? And that's some of the things that you kind of have to factor into. Okay, the stock price is down, but what's threatening the future cash flows and the company's growth? That's what you got to also pay attention to. Now, if we look at the company as far as earnings, the industry is 35, the company's 35, and the market is 16.4. But you really want to compare apples to apples. So if we're looking at it from a PE ratio perspective, the industry and Netflix, so it's not that as far as big of a deal because it's keeping up with the industry. The earnings growth, you would like to, from a value perspective, you would like to see that 1 and below. But in these days and age, from my experience, most companies out there in this given market with higher valuations than historically, it's most of the time it's going to be much higher than that. Now, as you can see, this is also good to mention. This future cash flow, as far as forecast annual earnings growth, was 16.6%. Now, I believe that number actually goes down to about 10% recently. So that will actually affect the future cash flow, which make this price will be actually, as far as the fair value, probably a little bit lower. Now, as far as analysts forecasted growth, Netflix, as far as forecasted annual earning growth, 6.6, and forecast earnings growth, which will be 10.7. So as we can see, the industry is expected to grow faster than Netflix. That's something you might not particularly want to see, but yeah, it's just good to know. Now, the good thing about Netflix, the future return on equity looks really high, 26.7%. But also you got to keep in mind, if the company has a lot of debt, this could actually be screwed. As we also can see, the return on assets is better than the industry, 13.2, and return on capital employed, 7.2. So that is very good to see. Now let's look at their financial health. As we can see, their financials is not so well here. We have the short-term liabilities actually greater than the short-term assets. Of course, the long-term assets is much higher, but we would like to see the assets of the assets cover the short-term assets cover short-term and long-term liability. So because they're a streaming service and they spend a lot of more money, it may be acceptable. But as far as a financial powerhouse, the financials could definitely be a little bit better. The good thing is they have a lot of long-term assets, which is also pretty good. But as far as the immediate term, if they need cash on hand and stuff like that, it's much lower, and they have a lot more liability. So, and also if we look at debt, Netflix is accumulate a lot of debt. I also like to see the cash. The cash is in green. Well, the debt is in red, equities in blue, and cash is in green. So as you can see, they all have a lot of debt. They almost have more debt than they have equity. I guess you can think of equity like a stake in the company. Yeah, so that's not particularly something we would like to see. And we also see their cash is also getting lower and lower. So you definitely want to keep in mind. So from a financial perspective, as far as financial health, I think it's in a weak state here. And also, let's look at the balance sheet. Their balance sheet is at least they do, even though they had that 15.4 billion in debt. If that wasn't there, everything would be smooth and sandy. So I would like to pay attention to the ownership. As we can see, there's been a lot of buying in the past by one individual. I believe you guys know that name. I'll pull up the article. I actually talked about it, where they bought 19.3 million in the past 0 to 3 months. Actually, this was in the past month. I actually did an article a reel on that. So let's also see the breakdown of who owns it. So institutions own 83%. So institutions really can control the stock price. General public is 15%, and state and government very small, and investors inside are 1.3. So next, let's look at and this is the one that I just recently added as far as the technical aspect, from the technical analysis. I'm trying to, make my videos a little bit diverse. So right now, as far as a trading perspective. I like to look at Netflix from a longer time period, because the longer we look at Netflix as far as the supports and resistor, I think the better idea we can end up getting. And Netflix, this is the stock price, and as you can see, this green line in red, the green, blue, and red, the 200-day, the 50-day, and the 20-day. So a lot of times these are key aspects that people would like to see. So you would definitely like to see it above the 200, the 50, and 20-day as well. That's also good to see. As far as, touching, as far as dips, we've seen a strong support here. I just drew these lines roughly. I want to say about, let me see what that is, about 243. So we've seen 1, 2, about 3. So we've seen a strong support since 2008, since at the about 40. And then we've seen another strong support at about 390. That's where it dropped a little bit before. Keep in mind, when I draw these lines, it's actually like a range, so it's probably within that particular range there. So I just drew the line, but it's actually a range. Now, as we can see, another one as far as the key support was about 469, but of course that one was like the median, I want to say, since 2020. We've seen that drop goes below there, and I'm looking at it. We do see a strong support here, but the only thing we have to remember, as far as Netflix, the next support would actually be right here at about the 247. So if things, especially with the overall economy, get worse and stuff like that, and stocks only have a pullback overall, we could see that it drop all the way there. Probably zoom in a little bit more. So if you were actually looking at it from a much shorter time period, here's our potential entry points you could get in, maybe at that 395, and then you would sell off at this probably like 469, because that was the last resistors. You could also, if you get to this particular point and you feel like it's going to have a breakout, another particular sell point is at 551. If you're looking at it from a technical analysis perspective, I just kind of like doing something really general to give you guys an idea to see from a technical perspective. Now, whether I think Netflix is a buy, at first, before I did a stock analysis, I thought Netflix was a great buy. But after carefully assessing and doing the stock analysis, as far as the stock analysis, I actually bought a small amount of Netflix. But after doing a carefully assessment, looking at the pros and cons, I don't really think it's a steal. If you was going to buy Netflix, I would buy it some very small portions. If I'm going to buy the dips, a very small amount. As we can see, the multiple is 35. As you can see, other ones like Facebook has dropped down to like a PE of 15. So Netflix dropping down to a PE of 20, it could happen. They're also one-dimensional. So as far as the subscribers, their business is one-dimensional. If they have multiple streams of income, like the other ones, like the Amazon, Disney, I would be a lot more optimistic about it. I do think the market is overreacting, so I have bought a small amount of Netflix. I think Netflix will recover. The lower, if Netflix drop within the 300 mark, again, I'll probably buy a good amount. But if we see a multiple of Netflix dropping down to a P/E ratio of maybe 15 or 20, I'll definitely buy a lot more. So I bought a small amount, but this is definitely, it is a buying opportunity, but it's not a steal. It's not like a no-brainer. The stock has definitely having some problems as far as the subscribers growth, the business model. Now here's the thing on the opposite side. So as far as the pros, they're the market leaders. They had some great breakout hits. They got a lot of opportunity as far as international. Their price is attractive. And here's the also thing. Netflix can also put in ads as well. If the other one have ads, but if Netflix decides to end up increasing ads, it can definitely increase their small amounts for these stocks like this, because they can keep falling. So I don't want to catch a falling knife, but like I said, I do think the market is overreacting. But that's what I think. If you haven't already, make sure you hit the like button. If you're new, make sure you subscribe to my channel.